Ever get that feeling, like you finally kind of figured things out, at least when it comes to the markets?
Oh, yeah, that I've got this investor swagger.
Exactly. Well, today we're diving into a newsletter that might just take that swagger down a notch.
Sounds intriguing.
We've been digging into the latest from the Macro Butler. It's called Money Aced.
Money aced. Okay, I'm listening.
And let me tell you, it paints a picture that's less smooth sailing ahead and a lot more like, uh-oh, is that a leak in the lifeboat?
Uh-oh.
Our mission today, to sift through it all and pull out the must-know insights for you, our savvy investors, especially as we try to navigate, well, what are shaping up to be some pretty, let's say, interesting markets.
Sounds like a plan. Let's dive in.
So right off the bat, this isn't your typical, everything's coming up roses market analysis.
Right. Not exactly sunshine and rainbows.
It takes a more skeptical look, maybe even a slightly cynical one, at how some of those 2024 market darlings have been doing. Your big tech giants, the whole Bitcoin craze, that AI-fueled NASDAQ surge.
Yeah. What happened to all that to the moon talk?
Well, according to the newsletter, it seems like someone may have let the air out of that balloon in the first few months of this, quote, Jubilee year. The confetti's settled, and those sky-high gains, poof, vanishing faster than free snacks in a trading floor break room.
Ouch. Not the best image.
And it's not just a gentle slowdown we're talking about here. The newsletter, it doesn't shy away from making some, well, let's say, pointed comparisons to history's most infamous financial crashes.
Oh, like what?
Think a little South Sea bubble, a dash of dot-com bust. It's a cautionary tale, for sure, but delivered with a surprisingly dry sense of humor. I kind of appreciate that.
A bit of dark humor never hurts, especially in the markets.
Exactly. So let's jump right into it with and I'm using air quotes here, the Maleficent Seven.
Maleficent Seven? Wait, you mean the Magnificent Seven? What's with the name change?
Good catch. That right there tells you a lot about where this newsletter is coming from. It's not exactly feeling the magic anymore.
Okay, I'm curious. So what's the story there? What's happened to these market titans?
Well, what's fascinating is how differently they've performed this year. Take Tesla, for instance. It's been the worst performer of the bunch by far, really taking a beating. And then you have Meta, good old Facebook, and it's the only one that's even remotely close to matching the S&P 500's gains.
Interesting. So the others are lagging behind.
Big time. Some more than others. It really makes you wonder if that whole idea of the Magnificent Seven as this unstoppable market force, if that started to, crumble a bit.
Crumble is right. That's a pretty big shift from where things were just a year ago.
Absolutely. Now, speaking of hype cycles, let's shift gears and dive into the world of AI. The newsletter takes a deep look at OpenAI's Project Orion, which was supposed to be the next big thing in AI, the next generation of ChatGPT. They even called it ChatGPT-5 initially. But then something happened.
Yeah, I remember hearing about that. What was the deal with Project Orion?
Well, it really boils down to the challenges of scaling these massive language models, these LLMs. You see, they're incredibly expensive to develop, and the improvements you get for all that money and effort, they seem to be shrinking.
Diminishing return.
Exactly.
Yeah.
ChatGPT-4, it cost a whopping 10 times more to train than its predecessor, ChatGPT-3. But did it deliver 10 times the performance? Not really. And then there was Project Orion, intended to be ChatGPT-5, which would have needed 25 times the computing power, not to mention a price tag of $500 million every 6 months.
Oh, $500 million every 6 months for what? Did it at least achieve world peace in its spare time?
Well, not quite. In fact, the results were kind of underwhelming. The rate at which it just made stuff up, what they call the hallucination rate, it was still pretty high, 37%. And get this, Baidu's ERNIE 4.5, it apparently performed even better and for a lot less money. So it really begs the question, are we just throwing money at these giant AI models without really getting much in return?
That's a good point. So maybe the AI revolution isn't happening as quickly as we all thought.
Well, it's definitely more of an evolution than a revolution, right? More like slow and steady wins the race instead of, bam, instant AI overlords.
I can live with that. As long as they're friendly overlords, I suppose.
Huh. But hey, even if the progress isn't as dramatic as some might have predicted, the overall generative AI market, it's still projected to be absolutely huge, right?
Oh, absolutely. No doubt about that. We're talking about a market expected to hit $1.8 trillion by 2032 with a 30% annual growth rate. That's massive. It's expected to have a major impact on a whole range of industries, from the hardware manufacturers to the software developers, even advertising and gaming.
So it's not just about AI chatbots then?
Not at all. We're seeing businesses of all kinds investing heavily in AI, and techniques like RAG or retrieval augmented generation are becoming more and more common. It's basically a way to give AI access to a huge, up-to-date library of information so it can fact-check itself, so to speak, and be more accurate.
That makes sense. So the money's definitely flowing into AI. The newsletter mentioned something about a capital expenditure boom.
Yeah, it's really remarkable that the big players in cloud computing, those hyperscalers, they're on track to spend something like $340 billion this year just on AI infrastructure. And that could even go up to $371 billion next year. That's a
Yeah.
lot of zeros.
Yeah, that's a mind-boggling amount of money.
Yeah.
But the newsletter raises a really interesting point. What if all this investment is focused on just building these massive training models rather than on actually using them for, real-world applications, what they call inference? They talk about a potential CapEx cliff if that spending doesn't shift towards making AI useful in everyday life.
That's a really important point. It's all well and good to have these super powerful AI systems, but if they're not actually being used to solve problems and create value, then all that investment could end up being wasted. It's like building a Ferrari and then just leaving it in the garage to admire.
Yeah, not the best use of resources. And speaking of resources, there's a pretty interesting competitive landscape developing in the AI hardware space, isn't there?
Absolutely. You've got Elon Musk's XAI building this enormous GPU cluster, which is pretty much what you'd expect from him, right? Go big or go home. But then you have this company called DeepSeek, and they've apparently made some major breakthroughs with smaller, more distributed computing setups. This could actually change the whole game, making those massive, centralized training facilities less essential in the future.
Okay, so let's recap for a second. The Magnificent Seven are looking less and less magnificent. AI development has some serious cost challenges, and there's a huge wave of spending that might not be going to the right places. Now, all this brings us to the core of the newsletter's argument.
Yeah.
The money est. What exactly does that mean?
So here's the thing. Despite all the hype, all the billions being poured into AI, none of the big companies developing these large language models have a clear path to profitability.
Wait, really?
Really. The newsletter points to OpenAI and Anthropic. They're both burning through cash at an alarming rate. Even Microsoft, which has been integrating AI into pretty much everything they do, it's likely facing similar challenges. The bottom line seems to be that the cost of developing and running these AI models is just too high right now to make a sustainable profit.
So everyone's spending like crazy, but nobody's making any real money.
Basically. And the newsletter goes even further, suggesting that these foundational AI models are at risk of becoming commodities, like interchangeable parts.
Interchangeable. So, like, instead of having a Coke versus Pepsi situation, it's more like generic cola versus slightly different generic cola.
That's a good analogy. When you have viable alternatives like DeepSeek that can achieve results comparable to the big names, but at a fraction of the cost, it becomes really hard for the more expensive options to justify their price tag. Their competitive advantage erodes, and they can't charge those premium prices anymore.
Okay, I see where this is going. And this is where the newsletter introduces the concept of round tripping. It sounds suspicious.
Well, round tripping in this context refers to this kind of, well, circular flow of money within the AI ecosystem. It's like a financial shell game where companies invest in each other, provide loans, then buy services or products from each other, all to create this illusion of growth and value creation.
So it's not real growth, just money shuffling back and forth.
Exactly. It's like a group of friends constantly lending each other the same $10 to make it look like they're all flush with cash.
That doesn't sound very sustainable. The newsletter even mentions vendor financing as a more subtle form of this.
Right. Vendor financing is when a company lends money to a customer to buy its own products, which can be okay on a small scale, especially in a healthy market. But the newsletter raises red flags about large-scale vendor financing involving companies that are already deeply in debt and losing money, especially when it's coupled with delays in financial reporting, which they point out is happening with one of NVIDIA's biggest customers.
That's interesting. And didn't they say that NVIDIA's accounts receivable has jumped up significantly?
That's right. Which could mean that not all those sales are as, well, solid as they might seem. And speaking of solid, the newsletter actually has this whole diagram that tries to map out this round tripping with a company called CoreWeave right at the center of it.
Oh, yeah, I saw that. It looks like a pretty tangled web. Who are all the players in this financial roundabout?
Well, the diagram shows CoreWeave, Magnetar Capital, Blackstone, OpenAI, and NVIDIA all sort of intertwined in this complex financial dance. You've got bond issues, equity investments, GPU purchases, agreements for computing services, vendor financing, even ship rentals. It's quite a spectacle. And the takeaway is, well, the whole thing just seems really fragile, with money swirling around without necessarily creating any real economic value for, the actual users of these AI technologies.
Makes you think twice about all those rosy projections. And didn't Microsoft just recently cancel a pretty big deal with CoreWeave?
Yeah, a $12 billion option to be exact. And that, combined with reports that CoreWeave is actually losing money and racking up debt despite growing revenue, it just adds to the whole uh-oh feeling, doesn't it?
Uh-oh is right. And the newsletter uses this really striking image, calling CoreWeave's recent less than stellar IPO valuation a canary in the coal mine.
I like that analogy.
What do they mean by that?
Well, because CoreWeave is so closely tied to the whole AI infrastructure build-out, the fact that its valuation for going public was way lower than initially expected suggests that the peak of inflated valuations and irrational exuberance for the entire AI sector might be behind us. It's like a warning sign, that this rapid growth and all the hype might not be sustainable.
A reality check, maybe.
Exactly.
And what about SoftBank? They're known for making these huge bets on emerging technologies. What are they up to in the AI space?
Oh, they're definitely in the game. Masayoshi Son and SoftBank, they've poured a ton of money into AI, including this ambitious project Stargate, and they're considering investing even more in OpenAI. They've also been leading a bunch of fundraising rounds for various AI companies.
So they're all in on AI.
Seems like it. But there's a twist. The newsletter mentions that Sun has been getting cold feet about the Stargate commitment, which is interesting because he's usually so gung-ho about these things.
So even the biggest believers are starting to have doubts.
Well, let's just say that maybe some of the initial enthusiasm is starting to fade a bit.
Okay, so with all this talk about a money AIst and the cracks starting to show in some of the market's hottest trends, what kind of investment strategy does the newsletter recommend? They mentioned prioritizing return of capital over return on capital. What does that even mean for us regular investors?
It's a big shift in mindset. In an environment where the so-called AI boom might just be a way for insiders to get rich at the expense of everyone else, and with the possibility of an inflationary bust looming, the focus should be on protecting what you already have. The newsletter is all about owning real assets, like physical gold and silver.
Back to the basics.
Exactly. They emphasize that gold and silver have intrinsic value, they're not dependent on anyone's promises, and they act as a hedge against both market turmoil and unpredictable government policies. They also recommend diversifying into other commodities.
So swap those digital dreams for tangible gold bars.
Something like that.
What about cash and, more traditional fixed income investments?
Well, for cash, they suggest being strategic. They recommend short-term, high-quality bonds and treasury bills. Those offer stability and a little bit of yield without much risk, but they're pretty bearish on long-dated U.S. treasuries and bonds.
Really? Why's that?
They basically see them as uninvestable right now.
Wow. And what about stocks? Any advice there?
No. The advice is to go for companies with solid balance sheets, consistent earnings, and good free cash flow. They specifically point to energy and commodity producers as being more attractive than companies that depend heavily on consumer spending. The overall expectation is for more market volatility and lower returns, especially after you factor in inflation.
Okay, so batten down the hatches, focus on things that have real value, and be cautious about those high-growth, high-tech bets.
That's a good summary.
Now, how does the newsletter suggest actually trading this potential shift? They talk about a transition from an inflationary boom to an inflationary bust. What does that look like in practice?
They argue that the U.S. economy is moving from a period of high growth and rising prices to one of potentially stagnant growth, but with inflation remaining high. They use this ratio of the S&P 500's price to the price of gold as an indicator. This ratio has dipped below its 7-year average for over 2 months now, which they see as a pretty strong signal that things are changing.
So the good times might be over.
It's looking that way. And they advise investors to sell the rips, meaning take profits whenever the market has a temporary upward swing, especially in broad indexes like the S&P 500. They believe that the NASDAQ and the tech sector in general are likely to underperform the energy sector and other areas that are involved in producing essential resources.
Interesting. So time to shift gears and look for opportunities in more, grounded sectors.
That's the idea.
The newsletter wraps up by urging investors to stay calm, do their research, and rely on data, not just the hype from Wall Street.
Right. It's all about being proactive and using market signals to anticipate changes in the economic cycle instead of getting caught up in those overly optimistic narratives that Wall Street loves to spin.
Solid advice, I'd say. So the big takeaway from our deep dive into money AIst is this. Those seemingly unstoppable trends we've been seeing, well, they might just be part of a much more complex and potentially risky situation. The newsletter argues that there's a real danger of wealth being transferred from regular investors to those in the know, and it makes a strong case for shifting towards preserving capital, focusing on real, tangible assets, and taking a more defensive approach as the AI bubble shows signs of deflating and the threat of an inflationary bust grows.
That's a great summary. It really makes you think, doesn't it?
It definitely does. So to our listeners out there, I'll leave you with this. What steps might you consider taking to make sure your portfolio is prepared for the challenges ahead? Because let's face it, things are about to get interesting. And by interesting, I mean potentially bumpy.
Buckle up, everyone.
That's right. Thanks for joining us on this deep dive. Until next time.
See you then.